The first advance estimates of FY20 GDP in many ways reinforce all the fears that you've had about the economy. They tell you that the economy is weak on many fronts and that policy options are quite limited at this stage. The data came in on Tuesday telling you that GDP is expected to grow at 5% in FY20. Now, this comes as no surprise. You know that in the first half of the year, you've seen sub 5% growth. The RBI has pegged down its estimates at 5%. The CSO estimates at 5% real GDP growth are more or less in line with that. If you look back, you'll see that this is the lowest we've seen in terms of GDP growth all the way down to the financial crisis period. I'm just going to clarify here that BloombergQuint is using the back series of the current GDP series so that you have one comparable series across which we are looking at the growth rates. And if you go on the basis of that, then this is the lowest since the financial crisis period. Now, the numbers stack up in this manner for GDP, GVA, and nominal GDP growth. And of those three indicators, it is the nominal GDP growth which is the most worrying, down from 11.2% to 7.5%. Now, that's a weak number, a very, very weak number for India, has implications not just for corporate earnings, but most importantly for the government's finances. And I'll come to that in a minute. But the GVA growth number at 4.9% and the GDP number at 5% are much lower as well compared to what we had seen last year. Now, let's focus on the fiscal implications of this number, because remember, the real reason you get a first estimate, a first advance estimate for GDP is because it's important to the budget making exercise. It will now be the new denominator for the revised estimates that the government puts in the budget, and it in some ways will inform the FY21 projections as well. So if you do the math based on the new numbers, what you had was a fiscal deficit of 7 lakh crore, a little bit above that, and that divided by the projected nominal GDP of 211 lakh crore gave you a fiscal deficit of 3.3% of GDP. Now the denominator has changed and is lower than what was expected. So on the same absolute amount of fiscal deficit, you will get a fiscal deficit as a percentage of GDP at 3.44%. So that is already a fiscal slippage in terms of just actual numbers. Now, what the final numbers look like based on the revenue that the government garners, the expenditure cuts it actually puts in place, will be known at the time of the budget. But you know, based on these numbers, that is going to be a tough fiscal management act for the government in budget FY21, both on the backward-looking numbers and in the forward-looking numbers. Let's get back to GDP now and tell you what the internals of the GDP number look like based on the first advance estimate. These are some of the key sectors. Agriculture is more or less steady, but the real worry point is on manufacturing. 2% growth projected in manufacturing for FY20 compared to nearly 7% growth in the previous years. Remember, this is a large employment-generating sector, so the job implications of a weak manufacturing sector are important to focus on, although you may not get numbers. Similar story playing out in construction. 8.7% growth in FY19, 3.2% growth in FY20. Electricity and public utilities weaker at 5.4% compared to 7%. Some of the other sectors where we know there have been pressures, for instance, the financial, real estate, and professional services sectors, there you've got growth coming in at 6.4% versus 7.4% last year. The segment which is held steady is the government spending supported public administration and defense segment, where growth is expected to be higher at 9.1% compared to 8.6% last year. That's the sectoral breakup. If you divvy it up from the expenditure side, again, the most worrying number is the fact that gross fixed capital formation has literally fallen off a cliff to just under 1% growth after seeing a slight pickup in the previous year. Why has that happened? Well, a couple of reasons for it. One of it might be financing, the other may be confidence, and the third may be a slowdown in consumption, which has meant that capacity utilization numbers, which had just about started to pick up, has started to fall again, and capacity utilization is below 70%. The consumption story is also worrying because private consumption was the one thing that had been going right and had been reasonably steady, as you can see, for the Indian economy. Well, now you've seen private consumption growth fall to below 6% as well, and that's well below trend. Government spending remains strong. Some people have questioned that number because remember, this government spending number is based on the first 2 quarters and some information of the third quarter, but the government may be looking to cut expenditure in the fourth quarter. So the final numbers, according to at least two economists we spoke to, which is Shogato Bhattacharya of Axis Bank and Soumyakanti Ghosh of SBI, the final GDP numbers for FY20 may actually end up being lower than the first advance estimates. Well, that only worsens what you know is a really bad picture for the Indian economy.